Hello everyone, my name is Jeffrey. In this video, I'm going to talk about monetary union. So without wasting any time, let's begin. In this video, there will be 4 sections. So the first section is the introduction. I'm going to talk about the definition of monetary union, the idea and reason behind it. The second section is European Monetary Union, EMU. So this section will cover the planning and implementation of EMU in the past. I'm also going to talk about the Euro, European Central Bank (ECB), as well as Optimum Currency Area and the adjustment in EMU. The next section is recent crisis in EMU. I'm using the case of subprime crisis and sovereign default. And the last section is the conclusions on this topic. A monetary union, also known as a currency union, is an exchange rate regime where two or more countries use the same currency. In other words, it's an agreement between two or more countries creating a single currency area. In simple terms, you can also understand it as a group of two or more states sharing a common currency. However, there is also some special case where monetary union may also occur even if there is more than one currency, but this only happens when the currency have a fixed exchange rate with each other, so they won't face difference in value because of the exchange rate. Perhaps in the past, one of the most known monetary unions is the Latin Monetary Union, created in 19th century when most of the Europe currency was still made from gold and silver. Current monetary union is the European Monetary Union, EMU in short form, where there are 19 countries in Europe share the euro. After understanding the definition of monetary union, you may wonder why it is needed and what's the reason behind it. To answer this question, it can be best explained by using the concept of preferential trade agreement, PTA. So PTA is an agreement between countries that reduce the normal taxes on some imported goods. In PTA, there are some country members. So one important decision for them is to decide which type of future exchange rate regime to adopt, because they want to reduce the risk caused by the foreign exchange rate. So one option for them is to adopt a flexible or floating exchange rate regime. However, they can be buffeted by destabilizing changes in nominal and real exchange rate. As we know, flexible exchange rate allow the currency to change based on the demand and supply in the money market. So when there are some sudden changes, the country cannot fix it. So the second option is to adopt a fixed exchange rate regime. Again, the country can be stumbled into a balance of payments and currency crisis because of the lack of flexibility in adopting other policy to fix it. So the only option for them to reduce this kind of risk is to form a monetary union by sharing a common currency. This means the member countries do not have to worry about the difference between their currency caused by the exchange rate, because they only trade services and goods based on a single currency. That's why there's a good consequence of using this exchange rate regime. They can avoid exchange rate instability. However, it is also important to remember that the member country in the PTA still need to decide on the exchange rate regime for the common currency against other major currencies. So even though they do not have their own currency, they still need to gather together to decide which type of exchange rate regime for the common currency. European Monetary Union (EMU) is a monetary union among 19 countries in which euro serves as the shared currency. The euro is administered by the European Central Bank. During the initial years, the euro was used only as a unit of account and for electronic transactions. But beginning from 2012, euro is a legal tender in the EMU member countries for all types of transactions. And because of its size, it is an important component of national government foreign reserve. And also important to remind you that a European Union member does not necessarily mean a EMU member. So let's look at the tables on the right hand side. As you can see, Denmark, although he joined European Union in 1973, is not a member of Eurozone. Same goes to Hungary. He joined European Union in 2004, but again is not Eurozone member. So both of these countries have their own currency. In 1999, there were only 11 members: Austria, Belgium, Finland, France, Germany, and more. As you can see in the right-hand side of the slide, there's a picture. It shows the original members that joined EMU in 1999. It also shows the original currency they used before joining the EMU. Countries like Portugal use Portuguese escudo. Spain used Spanish peseta before joining the EMU. This picture also shows the subsequent members that joined EMU after 1999. Greece, for example, joined EMU in 2001. As we can see, EMU is not an accession with fixed amount of members. As the years go by, the amount of members can keep increasing. Besides, there are several mini-states and territories that use the euro as their legal tender. So, given the size of EMU, approximately there are more than 300 million people. The bloc is an important component of the world economy in its own right. Next, I'm going to talk about the planning of EMU. So this slide shows the time frame of planning EMU in the past. In 1951, during the post-World War II period, the European Coal and Steel Community was established. 7 years later, it became the European Economic Community. At that time, there were occasional suggestions that work should be undertaken towards monetary union. 1970, the real monetary union was begun when the commission chaired by the Prime Minister of Luxembourg issued a report for a step-by-step movement to EMU. 1978, the European monetary system was introduced. It was being a fixed rate system in 1979, and then new currency was created called the European Currency Unit, ECU. 1994, the European Monetary Institute, EMI, planned the future European system of central banks, ESCB, and to plan the course towards monetary integration. They also aim to monitor the progress of member countries toward meeting a set of convergent criteria. And finally, in 1999, the European Monetary Union was created. After the meeting of EU members in Madrid in 1995, the euro was introduced in January 1999. They also adopted the EMI plan for monetary integration. So this slide is just a summarized time frame of planning EMU. In the next slide, I'm going to show you more detail. So this is a table that shows the evolution of European Union. It's basically the same as the previous slide, but the table here shows us the member added in a particular year. Now I'm going to talk about the implementations of EMU. The day of reckoning for the EMU came in May 1998, when the European Council met in Brussels to determine which country was to take part in the EMU on January 1999. In order to become a member of EMU, there are some criteria that this candidate should fulfill. So the criteria is called convergent criteria. They are economic-based indicators EU member states must fulfill to enter the Eurozone. So unless the country fulfill all these convergent criteria, otherwise they won't be accepted as a member. So the first convergent criteria concerns with price stability. In other words, it's about the inflation rate. So to become a member of EMU, a country should maintain stable inflation rate to avoid price stability. Next, the second and third convergence criteria concern with central government deficit and debts. So in order to become a permanent member of EMU, a country should maintain its deficit and debts as low as possible. As I mentioned it before, first criteria, price stability, is concerned with inflation rate. So the graph here shows us the inflation rate for 6 countries included in EMU with the highest inflation rate in 1990. So from the graph, you can see this country and this country have the highest inflation rate in 1990. And they are Portugal and also Italy. But it will decrease over the next few years, as you can see from the graph. In 1998, right before 1999, the year of EMU, none of these countries have the inflation rate higher than 4%. That's why all of them were accepted as a member of EMU. So we can say that there were a significant degree of convergence in inflation rate between 1990 and 1998, which is a relatively short period of time. And they are accepted as a member because they fulfill the first criteria, the price stability. Second and third criteria, government deficit and debts. So actually nearly all of the candidates for inclusion in the EMU had made significant progress in the area of government deficit. Regarding government debt, there were 2 countries stood out as not having met the convergence criteria, Belgium and Italy. If you look at the pictures on the right hand side, Belgium and Italy has the highest percentage of government debts in relative to their GDP, while other countries maintaining around 60%, but they are beyond 100%. So actually they cannot be accepted as a member of EMU, but the European Council chose to give Belgium and Italy a pass because of political decisions. So the same goes to Greece. As you can see, it has a percentage of government debts in relative to GDP that is higher than 100%. But again, because of political decisions, they are accepted to become a member. So now I'm going to talk about European Central Bank, ECB. So the centerpiece of the EMU is the European Central Bank. The primary objective of the ECB in its monetary policy decision is to maintain price stability within the EMU. So the ECB is required to maintain annual increases in harmonized index of consumer prices at or below 2%. This is widely regarded as a very stringent rule. Now look at the diagram on the left hand side. So the ECB actually plays 2 roles within European Union. So first, with regard to the European Union, is the centerpiece of the European System of Central Bank, ESCB. Originally, it had been assumed that all European Union members would be the member of the European Monetary Union, but we know now that it's not the case. Countries like Denmark and Hungary, they did not join the EMU, but they are the member of European Union. So second, the ECB is the centerpiece of a subset of the ESCB that has become known as the Euro system, which consisting of all central banks of the EMU members and the ECB. Eventually, if and when all European Union members join the European Monetary Union, the ESCB and the Euro system will be one and the same. So there will be no difference between Euro system and European system of central banks if all European Union members join the EMU. Next is just a pictures of the European Central Bank Euro Tower. The next section is about the Euro. The Euro was launched in January 1999 when EMU member exchange rate became irrevocably locked and monetary policy was transferred to the ECB. The value of the euro was initially set at 0.85 euro per 1 US dollar or 1.18 US dollar per 1 euro in a flexible exchange rate regime. As seen in the figure beside, The euro value initially fell against the US dollar and the Japanese yen, despite the predictions that it would appreciate in 1999. However, from 2001 and 2008, the euro started to increase against the yen and dollar, but with the onset of crisis in selected euro countries, the euro began to weaken again. The next section is optimum currency areas and adjustment in the EMU. There is an idea in international economics that is important to our preceding discussion of the EMU. This is the notion of an optimum currency area. An optimum currency area is a collection of countries characterized by the following. So first, it has well-integrated factor markets. Besides, it also has well-integrated fiscal system, as well as economic disturbances that affect each country in a symmetrical manner. Most observers, for example, agree that the United States constitutes an optimum currency area. Labor and physical capital are quite mobile among the states of the United States, and there is a great deal of integration of fiscal system through the US federal government. Finally, cycles of recession and recovery tend to affect each region of the United States in a somewhat symmetrical manner. In the case of the EMU, there seems to be less evidence that it constitutes an optimum currency area. First, despite the fact that EMU is a subcomponent of the EU, which is in turn a common market, both labor and physical capital are less mobile among the countries of the EMU than in the United States. Second, the budget of the EU is relatively small in proportion to the size of economy involved. This indicates a lack of fiscal integration of the EMU economy. Third, business cycles among the members of the EMU are somewhat asymmetrical, with the potential of one country experiencing an expansion while another experiences a contraction. The absence of an optimum currency area in the EMU leaves some room for worry about how economic adjustment will occur within it. In the face of a recession in one country, unemployment can be addressed in four ways. So first, an overall decline in wage rates leading to increases in quantity demanded for labor. Second, labor mobility out of area of unemployment. The third one is expansionary monetary policy at the EU level. The last one is expansionary fiscal policy at the member country level. However, in practice, this adjustment pathway proved to be difficult. So the first of these potential remedies, declining wages, can in principle address unemployment problem. It can be best understood by using the following equation. Foreign currency rate for member I equal to 1 over exchange rate times nominal wage over the EMU-wide price level. With the EMU in place, the foreign currency rate can no longer be reduced by national currency depreciations. That means there will be an increase in exchange rate. So the only thing they can do is to increase the EMU-wide price level or decrease the nominal wage. But an increase in the EMU-wide price level is ruled out by the policy of the ECB. This is because the ECB must ensure that the EMU-wide price level only increases 2 percentage points a year. So a decrease in foreign currency rates can only be achieved by a decrease in the nominal wage. But this is difficult because this tends to be downward inflexible in the EMU because of its labor markets. The second remedy, labor mobility, could likewise help achieve adjustment. But, as I just mentioned before, labor mobility within the EMU is not very strong. So the next potential remedy is monetary policy of the ECB. Recall that ECB is required to maintain annual increases in the harmonized index of consumer prices at or below 2%. It therefore has a very little discretion to pursue other adjustment measures. The final potential remedy for unemployment is national fiscal policy. But this policy is limited by the EU stability and growth pact that limits deficit and debt. So because of these considerations, some observers worry about how the EMU would operate in practice as a less than optimum currency area. So next section is about Western crisis in the EMU. The Western crisis in the EMU is a 2007 subprime crisis caused by the housing price bubble in the United States and then spread to the rest of the world. It quickly began to affect banks in the European Union through their exposure to US mortgage. By late 2008, the EU convened an emergency summit to address the crisis. In 2009, difficulties centered on a subgroup of countries, included Portugal, Italy, Ireland, Greece, Spain with the unfortunate acronym PIIGS. Two countries of the PIIGS, Ireland and Spain, also experienced housing booms that came to a rapid end in this crisis. Greece and Ireland became caught up in fiscal crisis, and Portugal and Italy suffered from long-term fiscal weakness. The ramifications of this issue on external accounts can be seen in the graph on the right-hand side, which reports their current account balances from 1999 to 2011. As we can see, all of these countries are experiencing long-term currency account deficit through 2008, some of large magnitude relative to GDP. At the beginning of 2009, this current account deficit began to shrink. In mid-2010, first Greece and then Ireland were caught up in market speculations of government or sovereign default. Bond yield spread widened with Greece at approximately 12%, Ireland and Portugal at approximately 6%, paying much higher rates than Germany at approximately 2% on new 10-year bond issue. The European Union set up the European Financial Stability Facility, and the International Monetary Fund began to commit funds in order to help soothe the markets. Eventually, the EFSF moved into the European Stability Mechanism, a permanent bailout fund. From 2010 to 2012, European Union handling of what proved to be an ongoing crisis was not adept, seeming to lurch from one half measure to another. During this time, a focus was on Greece, which even in 2011 had a current account deficit of approximately 10% of GDP and received large bailout in 2011 and 2012. In early 2012, holders of Greek government debts underwent a haircut, having to exchange old bonds for a new one, and the value is less than half of the original value. In the history, this was the largest sovereign default. In September 2012, events seemed to take a turn for the better. Germany Constitutional Court gave it long-awaited approval of the ESM. The European Commission set out its plan for a long call for EU-wide banking union. Mario Draghi, head of the ECB, announced that it will begin to purchase the bonds of the PIIGS to aid in their adjustment and thus begin to act as a lender of last resort. At that time, bond yields began to decline, and this might have been a point at which the euro crisis began to resolve itself. In conclusions, in the previous era of capital control, it was possible to pursue an independent monetary policy within a fixed exchange rate system. But capital control has been steadily and slowly eroded with only appropriate taxes on a short-term flow in some cases. So the monetary union discussed in this video is to escape the limitations of both fixed and flexible exchange rate regimes. However, there are some limitations of forming a monetary union. As I mentioned in the previous slide, there seems to be less evidence that EMU constitutes an optimum currency area, and the adjustment in EMU is always a concern. This is because both labor and physical capital are less mobile among the countries of the EMU than other countries like the United States. So the most important issue that needs to be addressed at monetary union is to decide the exchange rate regime that should be adopted for their common currency. So they need to decide whether the common currency flow will be fixed against other major currency. That's all for this video. Thanks for watching it till the end.